If you're over 250K, DM me strategy and you can book a 30-minute strategy call for us to review the most recent tax return with you and spot missed opportunities and quantify the benefit or tax savings you could have received in working with us. If your income business owners need more tactics and planning and coordination, they need something that I call strategy stacking and not just one or two key moves in 1 year to minimize their tax burden. Hey, you guys, now that we're past April 15th, I'm going to be creating a lot more content going forward. What an incredible spring first quarter for our clients. Wrapped up, we did a lot of work in the first quarter, which is what we like doing so we can be forward looking for planning for our clients. I often find that when we have a previous tax year that's still open and lingering into the middle and third quarter of the year. Clients have a really hard time focusing on planning and momentum. So we try our very best to wrap up those tax returns in the first quarter. So if that's not you and you did file extensions, then perhaps this is pretty relevant for you. So if you are making over 250K in active income and you didn't proactively plan for your taxes, then it's quite likely you left tens of thousands of dollars on the table. And I feel like a lot of tax CPAs and pros will make that claim, but I've personally looked at 2024 tax return for one of our prospects who just wanted to see, where could we have added value? And in looking through his tax return for two legal entities and personal return, I found $40,000 of actual tax savings, not deductions. He wrote a check for $36,000 to the IRS in tax year 2024. And if he would have worked with us in that tax year, he actually would not have written a check at all to the IRS. So effectively would have saved him $40,000 in that tax year. So if you're watching this video, this is especially for flippers, wholesalers, builders, and operators who are doing multiple deals. This topic here, what I'm going to cover today, not ideal for rental real estate, passive investors. If you have W-2 with passive income, not ideal for you. Or if you're just starting out in the real estate journey, some of this may not be very relevant to you just because depending on the size of business you are and what you're facing from a business and tax perspective, you need different tools. And this is just designed for active builders, wholesaler flippers who are doing, let's say, in the neighborhood of, $1 million plus in deals and at least 250K of taxable income when everything is said and done before any tax planning takes place. So if you're writing a check to the IRS in the neighborhood of $40,000 to $60,000, this is going to be very targeted for you and relevant to you. So the problem that I see is that a lot of clients have basic entity level planning. For example, they might have an S corporation, they are working with a CPA, they might even be filing things on time, which this client actually didn't. They were extended, which is another thing that I find that if you're put on the back burner and filing right before the Senate due date, your accountant, your CPA, your EA, whoever it is, probably is not thinking about tax planning for you. They're just doing the tax filing, which is fine, but it doesn't save you whatever fees you're paying. You need a multiple back on that in terms of tax savings, and you're not seeing that. So there's just no real strategy that's tying it all together with what's happened in the business so far and the direction you're headed going forward. So the differentiator in other CPA firms and ourselves in the real estate space is that at higher income levels, tax savings are not going to come from just one or two moves, like the truck purchase, last minute actual spend, which is again not tax planning because you might be financing a vehicle, but nonetheless, it actually comes from stacking strategies correctly. So depending on how large your tax burden is how we stack strategies. So in some years, we have to stack a lot of strategies because you're bringing a lot of tax burden. In other years, maybe you have net operating losses that are carrying from the previous year, or your rentals in due as well against your, construction income or whatever the case is. So we have to establish baseline before we can start stacking strategies to mitigate your tax burden. And if you're just doing the filings, it's too late. Oftentimes, there's no capacity left to be able to think strategically about these things. So what strategy stacking actually means, it's things like these. It's dialing in S corporation compensation, very commonly missed. I often see that it's an audit risk from it being too low, but every so often I see that comp is too high for the owners. Recently, 2 different cases where comp was set too high and things are changing in the business. So dialing in your S corp compensation, and not just from an SE tax mitigation perspective, but from a retirement planning perspective as well, which is number 2, like layering in retirement contributions properly, making sure that if the owner is active in the business and the spouse is also active in the business, that we are thinking about both the S election and compensation plus, especially if there's ownership percentages for the spouse. But even then, so the retirement contribution piece is massive when it comes to related parties who are actually working in the business, which you have a ton of family businesses where the husband and wife are working in the business. Sometimes like young adult children are also working in that business, which makes the strategies even more enticing to be able to shift income in different buckets. Number three would be planning around basis for upcoming acquisitions. I know this is going to be not as relevant to a lot of you guys unless you're looking at acquisitions of another business streams, but I've had a couple of different conversations just this week where a local construction company in our area is buying another revenue stream and kind of bringing that into their mix. And so, I think these smaller acquisitions happen every so often. You may not think about them as acquisitions, but you're essentially buying a customer list or buying a book of business and then bringing on one of the owners to like work in the business. Happens more often than you think. And then the fourth one is timing income and expenses intentionally. This is the one that probably gets mentioned the most, which is that truck purchase before year end. So individually, they might move the needle a little, but stacking them together is where you're going to really realize your real savings. And also, you don't want to be overly aggressive if in a year in which you're already experiencing maybe a downturn in just overall income, or maybe I had a client recently who had about $1 million of flip inventory that he was bringing into the next tax year. So that fourth quarter, he just did not realize that much income because he had a ton of inventory. So it's like you really want to stack things the way the year demands it to stack, meaning we're not going to go do, 6 cost segregation studies in that tax year because it's just not needed, right? So we want to match, and we expect the 26 taxes business might be a much more bigger tax year just because he's carrying so much inventory into that first quarter. And here's another example. So this is a client I was just mentioning. I looked at their 2024 tax return as a way of, I do these financial analysis on just a tax analysis. If you're a prospect with us, I'll just take a look at your tax return to see if there's any places in which we could add value where opportunities are missed, right? So this is no cost to you, just our way of being able to prove that we are the right partner to work with a business your size. So that's exactly what I was doing with this client. I looked at their 2 partnership returns and 1 personal return, and they already had an S corp, and they thought, I made the S selection. My accountant told me to do that. I thought I was good, but there was no, what I found was there was no coordination between, is compensation optimized? There was no real retirement strategy beyond the basics. Like, it just haven't given it much thought. I asked him about, have you walk through what type of retirement account makes sense? And he has some real estate in the mix too. So traditional retirement is not as high of a priority for him, which is often the case with our clients, but it still is one of the strategies that needs to be thought through, especially if you're going to come up with cash at the end of the year to pay the IRS. Like, I just want optionality so we can move things in whatever direction we needed to prevent cash from leaving the business. Essentially, I'd rather pay your retirement account than pay the IRS, especially if, it's all legal, right? So if you have a SEP, a solo, a 401k with employees matching, there might be different ways of mitigating the amount of cost that the business, there is a cost associated with it if you do have employees, which they do, but you still have to quantify the benefit to say, is that worthwhile? Let's go that direction as opposed to just try to check the IRS. There was no planning around upcoming deals. There just wasn't any thought given to. There was an asset that was personally owned by this husband and wife team that quite a bit of depreciation. That it was a new asset in 2024. There was about $100,000 of depreciation they could have taken, and they just didn't pay any attention to it. So that's how they lost that 30 to 40K tax bill, where they just wrote a check to the IRS as opposed to being able to keep that money at play for them. Essentially incurred late filing fees and penalties and interest as well because they didn't file on time. So once we actually stacked those strategies, which there were about 4, I mentioned a couple of them here, there was about $40,000 of missed tax savings, and he's kind of in the same boat this year. Unfortunately, he's back, he's for 25 tax year, there's no planning, and so now he's kind of in the middle part of the year, so the cycle just kind of repeats itself, and he's very, very motivated to build up the right bench of professionals to be able to support him through the growth that his business is experiencing. So if that resonates with you, if you're like, yes, I know how to go do deals and create cash and create revenue, but I'm lacking depth on my team, maybe don't have a good attorney, but I've got a tax guy or tax gal, but I don't have an advisor, then this is relevant to you. Most high performing businesses, they don't really have a tax problem. They know what their requirements are. They just don't have a strategy that's a coordination of strategy between legal and tax and their bookkeeper, accounting, to be able to make it all work. And those 3, I think of them as departments. So even if you're not a big enough business to where you have a legal and tax department, you're outsourcing that. Maybe you have a bookkeeper. So you have those departments, they're just not sitting inside of your org chart, which is even more so you have to manage those relationships because you're one of many clients to a firm like us. So you feel like you're the one who's playing catch up on all different ends. I think that is a differentiating factor in that we are an advisor on your team and we work directly with the bookkeeping team as well. So really try to make the value add to where you're not doing the heavy lifting as a client. Last thing on this, if you made over 250K last year and didn't proactively plan your taxes as a small business owner, then you most likely overpaid. Most flippers and wholesalers and developers that I talk to have an S corp, they have a CPA, but no real strategy behind it. At this level of the game, tax savings are not going to come from one move, but instead they're going to come from stacking strategies. I just reviewed pre-tax returns for a client, for a prospect who had the S election, had a CPA doing their work, and overpaid $40,000 in tax year 2024 because their CPA did not optimize for tax planning. They just filed the tax return. Hey, you guys.